Today I'm going to analyze Nestle, one of the major food companies in the world. I already did the analyze around 5 months ago. At this time the stock price was around 93 euros. So now it decreased around 16% again. And I got the YouTube comment which is asking me if I can analyze Nestle again because it's almost at the 52 weeks low. Is it the right time to buy? So we're going to take a look at the financials to find out. The first thing we can recognize is a market cap of 192 billion Swiss francs, which equals around 212 billion US dollar. This is the current stock price multiplied with the shares outstanding, so it's already a huge company. And we can see here it's one of the largest, actually the largest food company in the world by the market cap. And we also have a dividend yield around 4%, which we can see here. They did increase the dividend many years in a row already, sometimes in the 2% rate, sometimes even more. So it looks interesting, and we're gonna take a look at the financial foundation. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. We can see here in 2019 it was around 92 billion. Then we had around 9% decrease in 2020. I think mostly related to COVID. Then we had the 3% recovery in 2021. Then in 2022, around 8% growth. And then in 2023, around minus 1.5%. So overall, it's not looking great about the revenue growth. And when we take a look at 2024, we can see here down 2.4%. So overall, we didn't have a revenue growth in the last 5 years, and it's not a check here. We don't really like to see that. The next thing we're looking for is free cash flow growth in the last 5 years. This is very important because the free cash flow can be used to pay back the debt, to pay the dividend, to pay the stock buybacks, or to invest in the business. So it's a very important number. We can see here in 2019 it was around 12 billion. Then we had a 15% decline in 2020, I think related to COVID. But then in 2021 we had again the 12% decline. And then in 2022 we had a 24% decline. And then in 2023 we had the recovery with a growth around 50%. So now we're at 10 billion again. And we can see here in 2024, the analysts say it will be around 9.7 billion. So it looks interesting. Overall, we have a free cash flow decline, and we don't like to see that. So it's not a check here. The next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. So what we're going to do now, we're going to take the 10.23 billion. Then we're going to divide it with the current market cap around 192. And then we're going to get the free cash flow yield. And now it looks around 0.0532, which means 5.32%, which is quite good. It's over 4%, so it's a check here. And I think it's look undervalued right now about the free cash flow yield. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. This is a very important number because if a company has too much debt, it can risk to go bankrupt, and we don't like to see that. So we're going to look at the debt, and we're going to look at the quarterly debt, so it's more accurate as well. So we can see here the short-term debt in 2024 around 11.2 billion. Then we're going to add the long-term debt as well. We can see here long-term debt around 54 billion actually. And then we're going to divide it with the free cash flow around 10.23. And then we're going to get the debt to free cash flow ratio. So the number we get is 6.43, which is over 5. It means in close to 7 years, we can pay back the debt with our free cash flow. So it's not a great number, but I would say it's not so bad as well. It's not a check here. We're going to take a look at the cash on hand as well. We can see here in 2024, it was around 6 billion. This is not bad. I would say they can use this to pay the dividend or to invest in the business. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. This can help the stock price to increase, and we like this especially when we think the company is undervalued. So we can see here the shares outstanding did decrease many times in a row, many times over 2%, which is a good number. They're buying back a lot of shares. We like to see that, and it's a check here for me. We can also see here how much money they spent on this dividend, around 7.8 billion, and they have a free cash flow around 10 billion, so they can pay this dividend. We can also see here how much money they spent on repurchase of common stock, so around 5 billion. So it means they spent more than the free cash flow. This means they use the cash on hand or they use the debt to pay the stock buybacks. So this is risky, especially if the company has too much debt. But at this rate, I think it's okay, especially if the company is right now undervalued. I think it makes sense to buy back their own shares. Now I would like to give my conclusion about this company. So let's start with a positive. So the free cash flow yield around 5.32% is very good. Actually, it looks undervalued. They also have a dividend yield around 4.03%, which is quite good. They did grow this dividend also many times in a row. They have a stock buybacks, which can help the stock price to increase. We like to see that, especially if we believe the company is undervalued. What we don't like to see is the revenue decline in the last 5 years, as well as the free cash flow decline. And we need to see if they can recover the free cash flow and the revenue. If you believe this company can have a recovery about this, then I think it's a good buy right now. What I also concern about the supermarket brands, because they can offer similar products but way cheaper, so you have to keep that in mind as well. For me, the financials look quite good. The balance sheet is for me okay. They have a little bit too much debt. They have a little bit cash on hand as well. So I think the balance sheet doesn't look so bad, but we have to consider that as well. If they get more debt, it's not looking very good about it. I think if you really believe in this company right now, that they can have more revenue in the future and can selling more products, then I think it's a good buy right now because it's close to the 54 weeks low. So I think it looks interesting right now to buy.